colleagues and fellow panelist Sam Kahan. Sam said, I'll get my verbology straight in a minute here. Sam said that economists are pessimistic and left the impression that we're rather dour people. And I think, as everybody in this room knows, in fact, we're rather wild and crazy guys and gals. We are the people who provided the statistical underpinnings for keg parties in college. And in fact, I mean, there's actually an upside. Trust me, we're rather exciting people, higher in the food chain in that regard than accountants and funeral directors. So in the interest of continuing this kind of fun, what I thought we'd talk about here is how long this expansion can last. And one of the reasons that it's fun for me is you'll never be able to find me by the time this forecast, this projection comes true. I mean, Sam and Brian talked about the near-term outlook, so you can pin them down in 12 to 18 months. But I'm going to lift the lid and lift the horizon. And by the time this stuff happens, you will have forgotten this presentation. So that gives me a great degree of freedom. So let's do two things right up front here. Let's review, number one, where we are, and number two, where we're going, and I'm going to present for you three different views on where this economy might head over the course of the next 3 to 5 years and maybe even beyond. But first, let's do an inventory of where we stand right now. Oh, I'm sorry, this is the advertisement. We actually offer stuff for free. Again, there's no such thing as a free lunch, but if you want to Twitter us, we do great free tweets, much to rival Donald Trump. And this is your opportunity to get free stuff from ACT on an almost daily basis. Okay, well, that was exciting. So here's a chart, the first of my 512 slides. And in this chart, I think there are two simple things that you can take away from this. And actually, Brian did hint at it. Number one, well, let me describe what it is. This is a profile of the expansion phase of our post-1960s expansions. And really, there are two takeaways that you can bring away from it. Number one, this has been a long expansion. In fact, if it lasts another year, this will be the longest of the post-World War II expansion periods. So that's takeaway number one. Takeaway number two, as you can tell down at the bottom row there, this has been an exceptionally slow expansion. I mean, these expansion periods in that post-1960 period have averaged about 4.5% for GDP growth and almost 6% for industrial production growth. So you'd have to rate this one perhaps a C- or a D with regard to growth potential. Now, again, I'm going to employ an economist's old trick, which is on the one hand and on the other hand. Everybody likes exciting growth. Everybody likes high growth. But perhaps this slow growth has enabled policy to be controlled and moderate and has helped extend the expansion. And perhaps it's eliminated the idea of excesses or boom periods like we had in the 1990-2000 period when we had the high-tech boom followed by the bust, or the housing boom followed by the bust. So maybe this very controlled, very restrained growth rate has enabled the expansion to have super long legs. Okay, under the overall guidance of steal ideas shamelessly and then incorporate them into your own, I am stealing an idea that appeared in the Wall Street Journal on the Streetwise column from James McIntosh. And he used this context to describe financial markets, but we're going to apply that to the economy. And he said there are three different frameworks that you can use to talk about where we're going over the next few years. Number one, to take an inventory of what we got right now, higher growth than what we've experienced over these last 9 years, and call it a sugar rush. Basically to say this is feeling real good while we're experiencing it, but it's doomed to end badly, and end badly in a recession that might occur as soon as 2019 or 2020. Perspective number two is to say we've actually experienced the pause that refreshes. That is to say, in 2015 and 2016, we had a mini recession, and the mini recession will help give the economy some legs, such that we will have the recession period. We all know it's out there somewhere, but maybe more like 2021 or 2022. And then the third perspective, which is if you take a look and consider the financial markets as sort of an oracle, maybe there's a message there if you listen really closely and really hard, and that says that we actually had a renewal, an almost reset, Control-Alt-Delete on the economy. And in fact, this one might have legs that would stretch out to the middle of the 2020s decade, which would be an exciting prospect indeed. So let's explore each one of those over the next few minutes. And then we can have fun with the Q&A session, the Stump the Chump portion of the program. Okay, so 2018 is sugar rush. Here's the context for that. First, the tax cuts came at a bad time. The economy was already accelerating and growing, and in fact, we got fiscal stimulus at what turns out to be the wrong time, when the economy actually had a sense of momentum, and in fact, we got a push ahead, moving to numbers that are unlike what we've experienced before, recording numbers like 4% growth in GDP. Number two, at the same time, we have oil price escalation. In essence, inflationary factors. So add in oil prices, add in tight labor markets, 3.9% unemployment. And in theory, you're all probably experiencing it in your own businesses and enterprises. It's hard to hire good people, and sooner or later you're gonna have to pay them. And number three, I'm sorry, you should also mention tariffs. Tariffs are an inflationary phenomenon, inflationary threat. So let's put it all together and say what that spells out is the Fed taking preemptive action against inflation, raising interest rates, and ultimately leading to an increased risk of recession in 2019 or 2020. We've talked about the yield curve, and let's just say if you're a yield curve disciple, and I think that's already been mentioned by both Sam and Brian, a so-called flat yield curve, which is when short-term rates, and this chart uses the 90-day Treasury bill. You can get an even earlier signal if you use 2-year Treasury note rates. But once this converges, that is to say the blue line meets the red line, that ordinarily is a signal that there's trouble ahead. You start looking for the exit door, and you start saying you've got 3 to 4 quarters to find it. So let us suppose that the yield curve flattens perhaps as early as the 4th quarter of this year. Then you've got 3 to 4 quarters, and what all that seems to spell out is recession in late 2019 or early 2020. So there's your sugar rush. High growth now, enjoy it now, Fed tightens up, fights inflation, and what gets delivered up is recession. So start heading for the exit. So that's thesis number one. Let's try thesis number two, which is to say, if you take a look at the history of these expansion cycles, at some midway point, GDP slows down. GDP slows down, in fact, to a rate of growth, rate of expansion that is half the rate that you've experienced over the course of the whole thing. And again, if you take a look at some of our longer expansion cycles, as this table shows, 1982 to 1990, that was a long one. That was perhaps you can call it the Reagan expansion. 1991 to 2001, perhaps you can call it the Clinton expansion. The relatively brief expansion of 2001 to 2007, and then what we've experienced so far. Those are the GDP growth rate numbers. And in each one of those, there was a mid-cycle break where growth fell in half. So you say, what does this do? It basically gives you the pause that refreshes, to use perhaps that overused phrase, as you get a little bit of invigoration because you create a little bit of slack in capital markets and in labor markets. So if this precedent holds true, then we've got some tailwinds that could last for the next 3 to 4 years and get us to 2021, 2022, 2023. So you don't have to run for the exit doors yet, but you do have to keep in mind the fact that there could be an event out there. Maybe that's what holds. So fine, okay, fine. Now what do we have here? The stock market. And this leads us to hypothesis number 3, which is if you read what the stock market might be telling us, maybe, just maybe, we have tailwinds that could last to mid-decade. So perhaps in one form or another you've seen this chart. Let's cast it in a slightly different way. Let's draw circles around retrenchments in the stock market, and expansion phases. So depending upon how you want to read the stock market retrenchment of 2015 and 2016, and then the let's say, refreshing phase that fell after that, that featured, number one, maybe a reconsideration of a deflation threat, that what the bond market and stocks were telling us from April 2016 to date. It's very similar to what we experienced in the vigor and momentum that financial markets have following a recession. I mean, take a look at the fact that the 10-year Treasury note went from a deflationary 1.36 reading to what we have now, which is 10-year rates in the 2.9% neighborhood. This belief that times are sufficiently bad or sufficiently challenging that deflation looms as a real threat has been turned around. And in fact, we're focusing on inflation. So if this holds true, then this expansion might have the ability to take us into the middle decade. So hypothesis number one, hypothesis number two, hypothesis number three. Do we know for sure? No. But if you want some Bayesian type priors, and this is really my personal view expressed to you, I'd give these kind of probabilities. 20% likelihood that this is the sugar rush. Take a look for a recession sometime soon. Build it into your business planning for 2019 or 2020, near-term event. Most likely, and I think this does conform with the overall ACT perspective, but if Sam wants to disagree, please do, because Sam sets the table with regard to our economic view. This is the pause that refreshes. So 2015, 2016 slowdown, translate that into that mid-cycle pause, and we get a little bit of energy that'll take us out for another 2-3 years, maybe beyond that. And then there's that third view, which is we actually did hit that reset button. And in essence, while it wasn't a full-blown recession, the mini recession that we experienced in our business in 2015 and 2016, in fact, set the table for another fairly long-lasting expansion cycle, and we're headed for record-breaking territory and then some. So 1, 2, or 3, best guess is the one in the middle, 2 and 3 shot. The other two surround that, and you can be the judge. And with that, thank you very much. Tim, back to you.
Thank you very much, Jim and Brian and Sam. So we've got some microphones that will be going around in terms of questions. If anyone wants to just raise a hand, feel free. It's good time for Stump the Chump.